Hi guys, Jared here with Day Traders FX. Let's talk about selling puts now. In the previous video, we talked about selling call options and how we do covered calls. We own stock, we sell options. I love this strategy. It's all this stuff right here. This is all very, very excellent stuff. I love doing it. Let's talk about the selling put side of things. So naked calls, naked puts, covered calls, all this kind of stuff. Let's talk a little bit about selling puts. I almost always like to sell a put to get into a stock. Now, we've talked about buying calls and puts. If I think a stock is going to go down, I might buy a put right here, buy put option here. And if I think the stock's going to go down, then I'm going to make money. And that's just the basics of buying a put, right? We've talked about the details that come with buying options, with being on the buy side. And that is, yes, if the stock goes down aggressively, I can make a lot of money buying that put, but time is working against me and the market needs to perform. It needs to move quickly, it needs to move big, it needs to do all this stuff. So that's the situation with buying a put. Now, if I sell a put, I do like selling naked puts. In fact, I like that a lot. So selling, this is naked put options, just means what I would do is I would say, let's say Southwest Airlines here, we'll go back to this example, this is trading at $47.59. Maybe I sell on Southwest, maybe I sell the, let's go back a little bit, maybe I sell the 18-day expiration $47 put, right? Now what this means for me as a trader, if I sell the $47 put, Southwest is trading at $47.59, and I sell the $47 put with an 18-day expiration. Now this is my option premium, right? So my bid and ask price. So if I'm selling this, I'm going to get closer to this bid price over here, 154. Usually we can get somewhere in the middle between 154 and 180, so we'll call this 165, right? Something like that. So 165-ish, let's say that we can get that, and the broker's telling us we might be able to get 167. So we'll just say 165, so that's $1.65 per option or $165 per contract. So if I sell this put on Southwest and I get $165, here is what will happen. If in 18 days at expiration, Southwest is above $47, I just keep my $165. That's it. That's done. If at expiration, and of course you can always close an option before expiration. That's something important to remember, is we can always close an option before expiration. If at expiration the stock is below $47, the broker will obligate me to buy the stock at $47. Now, that can be good, that can be bad, right? If Southwest takes a big dive and they're down at $44 and I have to buy the stock at $47, I'm not super stoked about that. But remember, I was able to make $167. Either way, I keep that option premium. If the stock is above $47, I just keep my $165, $167, whatever, and I'm done. If I let it run till expiration, and again, I can always close options before expiration, but if I let it run to expiration, then the broker will make me buy the stock, or I will get assigned the stock at $47. So $47, but I made $1.65 that I get to keep. So 47 minus 165. So even though I had to buy the stock at $47, my real entry price for the stock is $45.35 because I get to apply that $165 to the price of the stock. So I actually own the stock at $45.35 even though I, quote, was assigned the stock at $47. So that option premium is a big deal. So a naked put would be I'm selling a put right here, and again, if the stock price is below the strike, so stock price below put strike price, I have to buy stock at expiration, right? So that's how that works. That's selling a naked put. Now, if this is a stock that you want to buy anyway, that you're okay owning, that's fine. I'll sell naked puts all day long because most of the time I'm okay to own the stock. I want to own the stock. The downside, of course, here is if the stock makes a huge dip down, right? Then I own the stock at maybe a little bit of a higher price than I want to own it. And the other downside to this is if the stock makes a huge run up, then I only make that option premium, right? That $165. And if the stock makes a big, massive run up, my profit potential is limited, right? So if this stock runs up huge, I'm still only going to make my $165. Now again, going back to our option buying versus option selling, that's important because if the stock makes a huge run higher, it would have been better to buy a call option or to own the stock outright instead of to be short an option. But remember, the goal with selling options, right? In this case, selling a put, the goal is to make easy, consistent money, right? And when you're an option seller, remember, time is on your side. The market doesn't need to move big. And sometimes it's disappointing when you sell options because if the market does move big, you think, darn it, I missed out on a big move. And that's true. But remember, it's all about consistently winning. And being an option seller is much more easily profitable. You can more easily be a consistent winner in an option selling than option buying. Option buying, you make bigger money most of the time. Option selling, you make more consistent money. And the question is, which one would you prefer? So, in selling this naked put, if the stock price is below the strike price at expiration, I have to buy the stock. Of course, I can close this out anytime I want. But I will have to take a loss, right? If I'm selling a naked put and my stock price is way down here, and I say, you know what, I don't want to own the stock, I'm just going to take the loss. Then we have to take a loss, right? We have to take whatever the loss is of that naked put if we close early. What I always do is I'll almost never take a loss on a naked put. If the stock starts going down and I'm selling that put, which really means I want the stock to go up, right? I want the stock to stay above the strike price. But if it's going down and I don't want to own the stock, then I have to take a loss on the option and close it out early. If I don't want to take a loss, then I let the broker assign me the stock. I have to buy it at the strike price. But then, at that point, I own the stock, and I can just hold on to the stock until it comes back and get out with some profit. I can sell options on that stock that I own now. I can do a whole bunch of things. And remember, we talked about if I got assigned, if I had to buy the stock at $47 and I got paid $165 for that option, I really own the stock at $45.35 because I get to apply that $165 towards that $4,700 position that I now own. So I really own it at $45.35. So it's actually pretty beneficial to sell an option, to sell a naked put. We'll never sell a naked call. Just never, never, never. Almost never. But I would never do it. Selling call options attached to stock, great thing to do. Selling naked puts, that's a great thing to do as well, as long as you understand the parameters. Again, if the stock ends up above the strike price at expiration, the put expires worthless. I keep all of my $165 and I move on to the next trade. I do not own shares of stock. On a naked short put, if I sell that put and at expiration the stock price is above the strike price, I don't own stock and I get to keep the option premium alone. If at expiration the stock price is below my strike price when I'm short the put, then I can either own the stock, I can let it run till expiration and then I'll own the stock and I don't necessarily take a loss, I take assignment of the stock, or I can close, of course, that option out and take a loss if I don't want to own the stock. And that is a basic strategy of selling puts, how we're going to work with selling puts. There's a lot of things you can do with puts. This is one of the main strategies, selling a naked put. It's really a pretty good thing to do. It's pretty low risk. I like to sell puts to get into stocks as often as possible. If I can sell a put to get into a stock, it usually gets me in at a lower price. The benefit is, if I'm going, hey, I really want to own stock in Southwest, and Southwest is trading at $47.59. I'm going to buy it at $47.59. Fine. If the stock goes down, my stock position is going to be underwater a little bit. If I sell a put, I say, hey, I really want to own Southwest, but this feels a little shaky. Maybe the stock's going to come down a little bit. Then what happens is I can sell a put, and if the stock does come down, I can just let it assign me the stock, but I'll still own it at a lower price because that option premium I get to keep. That money that I was paid for selling an option, I get to keep that, and then I get assigned the stock, and I actually end up owning it at a better, lower price. So this is selling naked puts. It's a great strategy. I love doing it. Strongly recommend it for everybody. I hope that's helpful. Keep watching. We have so much more to talk about. Thanks, everybody.